Hello, everyone. Welcome to our presentation on the gold market. My name is Matthew Miller, and I'm an equity analyst here at CFRA Research. Given the impressive increase in the gold price in recent months, and of course a very noteworthy new investor in the gold space, that is Warren Buffett's Berkshire Hathaway, we think it's a good time to talk about what is driving that surge in gold prices and help investors determine whether gold should be added to their portfolios. Gold broke the $2,000 per ounce mark for the first time ever at the beginning of this month. Now this 10-year gold price chart shows a previous record high of around $1,900 in August 2011, and really the long road of reaching the new record highs. One thing many investors are unaware of, however, is that gold has actually been trading at historic highs in all major currencies except for the US dollar and Japanese yen now for a couple years. In 2020, gold has really benefited most of the year from a weaker dollar. And in July, another positive catalyst emerged with further deterioration in the US-China relations. And of course, earlier in the year, COVID-19 had a major impact on gold as well. The rapid increase in the gold price in 2020 has been remarkable and starting to really consolidate around the $1,950 to $2,000 per ounce range. So the question is, where is it headed from here? But first, let's look at its relative performance to other asset classes. Given what has transpired in 2020, it is probably no surprise that gold is one of the best performing asset classes year to date. And gold miners usually move at multiples above the gold price movement, making gold miners one of the best ways to play gold bull runs. The gold miner ETF GDX is up 40% year to date, far outpacing the S&P 500 and even the NASDAQ. Now, gold gets all the headlines, but silver has been an absolute beast in 2020. It's up around 50% year to date. This was not the case during the first quarter, given silver traded down in sympathy with industrial metals. This is because silver actually is consumed, half of silver is actually consumed for industrial applications. Now, since March, however, silver has posted a historic rebound and is up nearly 90%. As silver had underperformed gold for several years, and many investors have been looking at what is known as the gold to silver price ratio, which has recently been at historic highs when you compare the price per ounce of gold versus the price per ounce for silver. And many investors have been looking at this as an indication that silver will eventually catch up to gold on a reversion to mean trade. Following the surge in silver price recently, it is now trading closer to the 10-year average gold to silver ratio, which is around 70 times. Now, despite the rapid appreciation in the gold price, there are reasons to believe that we may still be early in the cycle. The COVID-19 pandemic is far from over. Central banks have aggressively cut interest rates, and this is often in combination with significant amount of quantitative easing. Governments have also implemented massive rescue packages to support their economies, which has ballooned the deficits and balance sheets at the Fed. And more stimulus is likely needed. The stock markets have recovered and are performing quite well. But what's really driving this? Is it market fundamentals or is it just easy money? All of this is supporting gold prices. All of that extra money being pumped into the system should eventually result in a surge in inflation and currency debasement. CFRA remains bullish on the outlook, and we expect gold to continue to increase through the remainder of 2020 and throughout 2021 as well. And this is driven by persistently negative real interest rates and higher safe haven demand. Now, this slide illustrates why we think gold should be viewed as a strategic asset that should have a place in most portfolios. Alternative investments are really sought after in pursuit of diversification and higher risk-adjusted returns. In our view, gold is the ultimate diversifier. It is uncorrelated to other asset classes. Gold's correlation with stocks has historically helped portfolio diversification in both economic expansions and downturns. and several studies have shown that gold can significantly improve risk-adjusted returns. Berkshire Hathaway surprised the market when it reported its new investment in Barrick Gold, especially since Warren Buffett has never said anything positive about gold. Several noteworthy money managers, on the other hand, have become increasingly bullish on gold, from longtime gold bull John Paulson to Stanley Druckenmiller and Bridgewater's Ray Dalio. Earlier this year, Ray Dalio was quoted saying, "Cash is trash." And he has been suggesting that investors should hold 5 to 10% of their portfolio in gold. So what does the Oracle of Omaha's investment in Barrick Gold really mean? The biggest takeaway in our view is that this is a validation of just how far the gold mining industry has come since the last major gold price cycle. In the last time gold experienced a significant bull run, gold miners went on a buying spree. They issued debt and pursued dilutive M&A. And this was at the top of the cycle. This time around, however, miners have a keen focus on capital discipline and generating free cash flow. Although gold prices have hit new record highs, management teams have remained conservative, using $1,200 to $1,300 per ounce gold price for their long-term capital planning. And recent large M&A deals have been done without paying significant premiums and were done as all-share deals rather than issuing debt. This has left the largest gold miners with pristine balance sheets. If you look at Barrick Gold in particular, it's a company that has a robust free cash flow profile, strong balance sheet, and attractive valuation. And therefore, maybe it's not that hard to believe that Barrick and potentially other gold miners are a perfect fit in a Warren Buffett-esque portfolio. On this last slide, we highlight our stars recommendation for gold miners. As you can see, we have buy and strong buy recommendations, or 4 and 5 stars across the board. The combination of a rapidly appreciating gold price and what is relatively stable cash operating costs in the gold mining sector, this is a recipe for significant free cash flow. And it's hard to find an industry with better prospects for earnings and cash flow growth in both 2020 and 2021, in my opinion. Our 2 strong buys in the group are Agnico Eagle and Wheaton Precious Metals. We view Agnico Eagle as the best in class in several areas. It has top-tier assets, a top-tier outlook for production growth, and best-in-class mineral reserve grade at around 2.8 grams of gold ounces per ton of ore versus the industry average of only around 1.6 grams per ton. We upgraded Wheaton Precious Metals to a strong buy what is a little over a year ago, mostly on the thesis that silver would outperform gold. In 2019, silver accounted for about 1/3 of Wheaton's revenue. In 2020, it could be closer to half of sales. We also have a favorable view of Wheaton's portfolio of assets, with about 3/4 of Wheaton's production derived from operations in the best quartile of the global cost curve. That brings us to the end of this presentation. I hope this update on the gold market was helpful. For more information on CFRA research, I encourage you to visit MarketScope Advisor at advisor.marketscope.com or contact us by phone or email. Thanks for listening today, and I hope you have a great day.